You've probably heard that the national debt is exploding. You know, something like $32 trillion. But does that mean we're headed for a debt crisis and we're all doomed? Not necessarily. In this video, I'll explain both sides of the argument about whether the US national debt is likely to become a problem and what impact it could have on your investments. Conventional wisdom says that when the government borrows more money, also known as having a bigger fiscal deficit, it requires investors to purchase more treasury bonds. If this trend continues, as it currently is, there will come a point when there aren't enough individuals or institutions who are willing or capable of buying such a large number of treasury bonds. As a result, interest rates will have to increase and the value of the dollar will decrease. Taking one step further, if the world then lost faith in the US dollar, it would collapse along with the US economy. On the opposite side of the spectrum, you have a new way of thinking called modern monetary theory. They make the point that since the Federal Reserve can print an unlimited amount of money, there is zero chance the US could ever default on the debt, no matter how much it issued. That is, unless Congress does something stupid, like fail to raise the debt ceiling. They say that for countries that can print their own currency like the US, borrowing isn't limited by how much the government could pay back. It's only limited by how much government spending the economy can handle without spiking inflation. I think both sides have a point, and the reality is probably somewhere in the middle. It's difficult to imagine that ever-increasing debt will never have a negative impact, but the idea that it's a Bernie Madoff style Ponzi scheme is also ridiculous. What few people understand about the US national debt is that it's not the same thing as debt for you or a company or even other countries, because the US can print money and the dollar is the reserve currency. Even Warren Buffett said,
"You do not need to worry. As long as the United States government borrows in US dollars, there is no possibility, none, of default."
What matters is not whether the US can pay back its debt. It can. It's at what point do investors start to lose faith in US debt and look for alternatives. And if that happens, the outcome is not a debt crisis or US default. It's gradually higher interest rates and a weaker dollar. In smaller, weaker economies like Zimbabwe and Venezuela, large, unsustainable debt levels have led to hyperinflation and debt crises. But the US economy's strength and the dollar's reserve currency status create built-in demand for US debt that makes those risks significantly lower here. The reality is that there most likely is a limit to how much we can borrow. We just don't know where it is. That's a scary scenario, because while the US national debt isn't likely to become a problem anytime soon, sometime down the road, it could. And we do seem to be headed down that path. The last few presidents have figured out that big promises like free college tuition, free healthcare, and building a wall sound great to voters. But when they're asked how they're going to pay for them, they never have an answer. But here's the trick they always pull. Right now, Biden says his plan will cut the debt by $3 trillion over the next 10 years. And Republicans say the bill they just passed will cut it by $4.8 trillion. What they won't tell you is that those numbers are starting from the Congressional Budget Office's baseline estimate, which is a $20 trillion increase. So they'll spin it as a $3 or $5 trillion cut, but it's really a $17 or $15 trillion increase in debt over the next 10 years. As a voter, if you want to do something about this, you can vote Libertarian. As an investor, one way to hedge against a weakening dollar will be to buy real assets like gold and commodities. Another option will be to invest in non-US stocks and bonds, which get their returns boosted when the dollar weakens. To be clear, I'm not advocating making decisions based on fears about the national debt, because I do not think it will be an issue anytime soon. But if you disagree with me, those are two ways you could go about it.